More on Ken Feinberg's executive compensation plan. Let's ask our roundtable of executive compensation experts. Nell Minow is the co-founder and chief editor of the Corporate Library, an independent research firm that specializes in corporate governance. She joins us from our Washington bureau. And right here with us in our New York studio, John Cornell, partner and executive compensation specialist at Jones Day, the third biggest U.S. law firm. And Nell, let me start with you. This plan laid out by Ken Feinberg, is it too aggressive or is it appropriate in your view?
I think it's very appropriate given the limited authority that he has in terms of the number of companies, the number of people, the time. I think it's probably a better deal for the taxpayers than it is for the shareholders because it provides a very powerful incentive for these companies to get out of TARP.
John, what about your view? Appropriate or is it too aggressive?
I'd agree it's appropriate from the incentive to get out of TARP, but I am concerned that even within the constraints of the statute, that there's too much damping down of the cash portion of compensation. As you know, the statute limits Mr. Feinberg's authority in some respects. It does not limit it in the respect of how much base pay can be paid in cash.
Nell, does it concern you that Ken Feinberg, with no private sector business experience, is setting compensation guidelines for companies that we want to be profitable? I mean, we do want them, one would assume, to eventually pay back the $700 billion that they're getting.
That's right. You know, what Ken Feinberg does have experience in is procedural fairness. He had to get into some very, very tough negotiations, as he did with the 9/11 Victims Fund and various other funds that he's been involved in. And so he's got a lot of credibility in that one area, and I think he did a good job. Yes, we want the companies to be profitable. Clearly, our past way of paying them wasn't making them profitable, so I think a better way to pay them is exactly what he's negotiated, which is less in cash, more down the road if the stock price improves.
Do we have to compromise, though, now on fairness and profitability? I mean, shouldn't we lean towards profitability if we want the money back?
There's no question about it. It's process fairness. In other words, the fairness of the negotiation process is what he's known for. But the outcome, I think you're right, is absolutely about profitability. And the way to do that, you know, it seems to me the United States is doing exactly here what any private equity firm would do if they had an investment of this order of magnitude in these failing companies. The first thing that you would do if you were KKR or BlackRock or the mob or your mother, whoever is going to give you money, is going to say, now let's talk about how you get compensated. I want to make sure that your interests are aligned with mine.
John, 20 seconds before we have to take a break, and we'll come back and talk some more. But you're still concerned that they're putting too many limits, if you will, on that cash portion. Well,
it's a top-down driven. It's not a fair negotiation between the executive and the mob or KKR, in Nell's words. But I think within the limits of what Mr. Feinberg has to deal with, he's done a fair job under the circumstances. My concern is that you may get turnover you would prefer not to have because people will seek other opportunities.
All right.